In today's episode, we're talking about Credit Suisse, Softbank, and the implosion of Greensill Capital.
It is Monday, March 8th. This is the Piper Rundown. We analyze business and culture to help you win. Today's rundown is presented by JetStore. JetStore has been providing affordable, reliable, and easy-to-manage data storage and cloud solutions to over 4,000 customers worldwide for over 26 years. That's longer than I've been alive, so they know what they're doing. JetStore offers storage systems for private cloud hosting, video surveillance, Internet of Things, AI, machine learning, edge computing, data archiving, HPC, media production, medical imaging, and flight simulations. For more details, visit jetstore.com. Thank you for sponsoring the rundown.
We've been critical of Softbank on this show in the past, and today's episode will continue that trend with the implosion of Greensill Capital. Greensill Capital, founded by Lex Greensill, is a supply chain finance company. They will paint themselves with the brush of fintech. They're just a traditional financing company, and they're imploding. There is a lot that goes into the story, so we'll be dedicating most of the video to explaining it. Here we go. Supply chain finance. What this company does is they structure and then sell derivatives associated with the invoices with large shipments across international supply chains. So what that basically means is there are suppliers, think manufacturers, and there are distributors or third-party vendors who receive shipment for a good after it floats across the ocean, after it travels across a train track, what have you. There is risk associated with that, and there is a time nature to that transaction occurring. If I make some widgets, I send it across the ocean to you, might take 30 days to get there. I might have terms of 30, 60, 90 net days for payment upon delivery being completed. And so therefore, I might make something, ship it, and it could take 3-4 months in order for me to get paid. In a profession like manufacturing, a industry like manufacturing, time is money, like almost any industry, and so therefore there is a time value to being able to bring those payments forward and being able to put that money back into the business so that you can make more stuff. What supply chain finance firms is basically sit in the middle of those transactions. So instead of that gap, in the case of a process called factoring, the manufacturer will say, okay, you pay me now, give me a 1%, a 2% slice off the top in order for me to get my money now, and then you go make sure that those invoices get paid.
Right.
On the flip side, reverse factoring, which is the domain in which Greensill was an innovator, says for that manufacturer, they come to the supplier and say, we'll pay your invoices right now, you can pay us later. So once again, it's all about the flow of money. When does money have to flow out? When does money flow in? And if we bring that flow closer to the present, that's a problem for some other day. The risk here is the way in which most of these suppliers are evaluated, and many companies are evaluated, particularly on this show, is their debt burden. How much money do they owe? On what terms? On what type of timelines? Deals like this obfuscate the amount of debt on the books for these suppliers, because instead of very legibly saying this invoice is due here, this invoice is due there, this is the balance that we have with this particular payer that we owe them money, it can be obfuscated behind the derivatives, which is basically now Greensill taking, okay, we have all these different suppliers who all owe us money, and we can charge a higher interest rate to these characters than a conventional low-yielding government bond in some way, shape, or form. And in a world where people are searching for yield, some investors say, man, this 3% return is better than a 0.2% return or something to that effect, and is hopefully secure, but that's not always the case. This is an enormous space, so the other part of the pitch here is, in addition to sprinkling AI or machine learning or whatever other bullshit, this is a $2 trillion flow annually of these payments from suppliers, from distributors to these suppliers, and even a relatively small 1% fee translates to $20 billion in fees annually.
That's so wild. And when I was first, it is no secret that I am no economics major, so all of this supply chain financing, all this stuff, relatively new to me. But even in just reading this, I was having trouble delineating, okay, what's the difference between this and just a regular bank? And this is just also something that major banks offer. But with Greensill, they are a smaller company, and they have been backed by Softbank as well as other people, but also Softbank is using their services to finance some of their companies.
And it gets more complex here because the way to think about the other bank is, so these banks, what large banks are fundamentally great at is accruing assets, accruing capital, and then being they'll call themselves stewards, but being the allocators of that capital and making these decisions. But they're not necessarily going to get the specialized provider around a specific domain. So what they're really doing, and the reason this is blowing up is because Credit Suisse has frozen 10 billion in assets that were being used by Greensill to finance these deals. They were basically saying, we've got the capital, you are the provider, the vendor that we're going with as it pertains to supply chain financing and those types of financial instruments. You're the provider we're going with as opposed to other players who also do supply chain finance. So here's a timeline for Greensill. Founded in 2011 by Lex Greensill. 2014, they buy a small bank in Germany. We're going to come back to that bank in a second. In 2018, July, General Atlantic invests $250 million at a $1.6 billion valuation. The next year, October 2019, Masayoshi and Softbank invest $1.5 billion in two tranches, getting a $6 billion valuation. And that is the peak of valuation for this company. In light of Credit Suisse freezing that $10 billion in assets and this entire supply chain finance empire unraveling, reports have come out that Greensill is considering selling their operating business for about $100 million to Apollo Global Management. So that is a pretty precipitous climb and then subsequent fall. Here is the essence of the issue that has been uncovered by BaFin. You'll remember BaFin was slow, very slow on the uptake to coming after Wirecard, a supposedly blue chip German fintech institution that had fraudulently assembled more than $2 billion in assets that didn't exist, and had been called out, raked through the coals for not actually stopping the short selling against this entity. So there's a bunch of regulators there who have some career risk, who realize that if this happens again, they were already starting to clear house, but everyone's going to lose a job. Yes. And there's nothing that scares people into action more than potentially losing their job. So what BaFin has said is that this bank that Greensill acquired has to halt all actions, particularly the issuance of new debt, because their loan book has some very funny numbers involved. The starting point is that since the acquisition of that bank, its balance sheet has exploded to a significantly larger size. And in general, that's something that we're used to hearing with tech companies. Man, they've, exponential growth of users, network effects, blah, blah, blah. In finance, explosive growth is usually more likely a risk factor and something's funny there as opposed to
like a solid thing to build off of.
Super cosign, right? Like Cash App has that exponential growth in users, but they're not actually exponentially growing in terms of assets under management. I'm not saying that Cash App and Square is all 100% perfect and kosher, but there's a difference in those two elements, right? So in this case, an explosive amount of loans. They've grown from about $1 billion in loans to $3.5. And what has been uncovered is that of that $3.5 billion in loans, $2 billion, more than half, is associated with one company. As recently as 2019, 5 clients made up 90% of that bank's revenues, and as recently as 2020, 70% made up the company's revenues. The number one rule of large financial, we've talked about this in the past. You get rich through specification and focus. You stay wealthy. You maintain your assets through diversification. This is like the first lesson, first day of finance. You de-risk, you try to create assets that are uncorrelated from one another, which is partially what attracted people to these supply chain finance products in the first place. It's supposedly uncorrelated from the other bonds that we might have in our portfolio. You do that by having a multitude of clients, a multitude of loan books that you are servicing, so that if one customer goes bust, if one customer exposes itself to undue risk, your entire thing does not collapse and implode. They didn't get the message. GFG accounts for $2 billion of that $3.5 billion in books. And once again, this was not immediately apparent because there are regulators looking for this type of stuff because of that obfuscation enabled by supply chain finance. When there are more than one party involved with these loans that you are servicing, it can look like, oh, it's the supplier that owes the money, as opposed to the large industrialist that is taking in money from all these different suppliers. So that was obfuscated. That is a company, GFG Alliance, if you've never heard of it before, with $20 billion in revenue, 35,000 employees, founded by Sanjeev Gupta, also the name of a doctor in the US. My mom pointed that out. Not that doctor, a different industrialist here. But this is all sorts of downstream effects. And another thing, have you ever heard the Peter Thiel-ism that monopolists will deny that they have a monopoly, and those that are not even remotely close to a monopoly will tell you how different they are and how unique they are?
Yeah.
So there's a similar effect here with powerful companies or companies trying to argue their scale.
Yeah.
So what's happening right now, the attorneys at Greensill are saying, this is a systemic risk. If we go out of business, 50,000 people could lose their jobs. Because if you think about it, there's a bunch of companies expecting this money to come in, and if that gets disrupted, trouble at the supplier level. You only make that argument when you're looking for a bailout, when you're looking for some sort of savior, and suggest that this might not be at quite the same level of risk that they are trying to argue themselves in order to get that bailout. But there is a negligence and, more importantly, a knowing flouting of the rules occurring. Yes. You don't get to $2 billion, more than 50% of your loan book, all being with one client without knowing it.
Definitely not. That would not fly here.
It sure wouldn't. And as we've spoken about in the past, if someone is committing fraud, if someone is taking actions that are knowingly, obviously illegal, unethical, morally dubious, there's usually more smoke, more fire immediately adjacent. So the two other elements of this story that are immediately confusing when explained plainly. General Atlantic, who gave that valuation of $1.6 billion, invested $250 million, received a loan from Greensill a year after making that investment. Making an investment into a startup, a fintech startup, and then receiving a sizable loan back is odd. That doesn't make a ton of sense.
Compute.
Similarly, Softbank, after making that investment, received a $435 million loan to another one of its portfolio companies. Now, the cynic will say, whoa. There is the idea with conglomerates, you get efficiencies by keeping this business internal, what have you. The issue is Katerra flopped, and it was a flop well in advance of receiving the loan. And in terms of there not being many frauds out there under the sun, a classic fraud is, I'm gonna give you some money, you're gonna loan some money to my company, that company blows up, and you just forgive the loan.
Yeah.
There's a reason that entities that have a banking license, that operate a bank, have severe restrictions and regulations on them, high regulatory scrutiny, because the capacity for bad behavior when you are self-dealing as a banking entity is exceptionally high. You have the ability to issue loans, which is basically the formulation of dollars more or less out of thin air whenever you want.
Yeah.
Greensill was not abiding by all the letters of the law here. That is why they've seen their valuation. I'm trying to do the quick math here. Going down from 6 billion to 100 million. Is that 6%?
Yeah. Net?
No, that's not right. The precipitous decline is partially because of that shady business. Another thing that anyone who's in the know in the world of finance has had their antenna up about Greensill for a while is this. Back when they only had $26 million in revenue as a company, $26 million in revenue as a company, they switched from a large auditing firm to a small auditing firm. Now, Ernst & Young audited Wirecard. Doesn't mean because you're worth a large auditing firm that everything's all kosher and good. But they went from a large one to a small one. That's a red flag.
100%.
But here's where it gets more interesting. So 26 million in revenue, $40,000 fee to that auditor.
Okay.
Now remember the opacity of this. Remember all the different suppliers, the complexity, the multiple shareholders. Their revenue, when it climbed to 336 million, 13 times the 26 million. What do you think that $40,000 auditing fee went up to?
50,000.
96,000. 13x revenue. Definitely not a linear climbing of complexity, likely an exponential, but at least a linear climbing of complexity. Their fee for auditing only went up 2.5x.
Yeah, that's a joke.
Not the first issue that Greensill has run into. Once again, smoke, there's fire. Vodafone is a major customer. They are one of these large supply chain companies. Turns out that the former treasurer of Vodafone has been hired as the CFO of Greensill. Also turns out that Vodafone is implicitly an investor with an equity stake in the company. Once again, shady if you own equity in the company and they are the person issuing you loans, creating your financing as a company. Very, very, very sketchy. If they seem to parade out the fintech moniker again. They use a third-party IT provider. They don't even have their own proprietary technology. Usually not the behavior of a genuine fintech fund, just someone creating some different products and doing it in a slightly shady way.
See, what I can't even wrap my mind around is, like, when you see all this laid out in front of you all together, obviously it's easy to see, like, oh, this has been shady for a while. This has been not run in the correct way. But over time, and when you're not factoring in all these different details, like, I imagine that this is what I'm struck by. It seems to me that this would be extremely easy to pull off with any company similar to this. Like, it seems like this can't be a once in a blue moon type of situation.
So it's certainly not the first fraud, and it won't be the last fraud. There's a very important story that Jim Chanos uses, an analogy that he uses. The fraud cycle follows the economic cycle. And in the nadir post-crash, everyone is hyper-skeptical. The only people that will get any sort of financing are the most rock-solid, persevering, ethical actors. And then as things slowly recover, they ramp up. People get a little bit more fast and loose. They see a few successes. They look for the next one. Yeah. The air of doubt starts to escape. And it hits its peak as things are at their highest point, because everything is working, everything's on fire. That'll work, that'll work, that'll work. And as soon as things start to crash, people start to look, and it's never, hey, we failed as capital allocators. Right. Hey, we failed as, it's our responsibility for not seeing the signs. Right. It's them. They're the bad ones. They lost us our money when the signs were there. There's plenty of people that have been speaking about Greensill being kind of not making any sense for years. And another thing, throw the comment up on the screen, AT. The person that commented that being a Softbank company made us slightly skeptical of Coupang, and that being BS just because of the one WeWork blow up, this is a sterling example, in addition to Qatar and these other Oyo hotels all blowing up with SoftBank money, there is a trend. Where there's smoke, there's fire. Where there's bad behavior allowed to persist in a certain investor's portfolio, it smears the rest of the companies, rightly or wrongly, with that same poopy smell.
100%.
So we are not wrong to just make note of that and know that that's who this entity chose to put on their investor cap table as opposed to someone else. And so this type of behavior, this type of self-dealing, that I promise you cannot do this type of multi-$100 million self-dealing without the people at the very top being aware of it. They'll deny, they'll have their attorneys use, well, by the letter of the law, this never quite happened, and so therefore blah, blah, blah.
Yeah.
Like, what kind of person is running a business allowing $100 million loans to be issued and not being aware of them?
Yeah, that just doesn't happen.
Are you kidding me?
Yeah, it's foolish.
So it will continue to occur. These things will continue to be unwound. And the real issue here is it comes down to Lex Greensill, the founder of Greensill Capital. So WeWork blew up. But the founder, the guy who knew everything, Adam Newman, got fucking paid.
Yep.
He got a fresh billy. He was able to walk away, and there was some legislation or fighting over that fee, but he walked away a billy. Yep. So he's walking away, pockets fat. He has no reason to amplify the situation. The issue is with Greensill here is his stuff's imploding. He's not going to walk away with a fat stack of cash, and he's clearly someone that prioritizes that in his life. No fault there. If he is staring down the barrel of severe fines, I don't know if actual time in prison will occur, but possibly, severe penalties. Yeah. This is someone who actually holds the keys to blow up Softbank and General Atlantic and explain what they were doing, why they were doing it. He has all the inside info. He has none of the incentive of, well, let me just protect my little pie and ride off into the sunset.
If he can cut a deal, if he can relieve some of those penalties.
That is the most interesting part of this story yet to transpire. There will inevitably be more shady dealings uncovered in the same way that we were finding stuff for WeWork, we were finding stuff for the Wirecard months, years after the fact. But that's the most interesting domino yet to fall. We don't have an answer to what will occur there, but we will be paying attention to it and we will cover it if it happens. If you found this valuable, if it helped you make sense of a relatively large business story that you either were not aware of or did not fully understand, we hope that you appreciate it. We hope that you'll hit subscribe, leave a comment, ring the bell. That not only helps you make sure that you don't miss future episodes of the Piper Rundown, but also helps us grow in the algorithm. Our goal this year is to hit 5,000 subscribers on this channel. That has all sorts of implications for the advertisers that we get to bring on, the projects that we get to pursue, the people that we get to hire and pay more to be a part of the Piper team. So you will be supporting those goals when you take those actions every time you watch one of our videos. We really appreciate it, and we appreciate you viewing the video.
That we do.
Prince Harry, Meghan, Oprah, CBS paid around $8 million for a 2-hour interview special. Yep. Oprah packaged it. She sold it, her production team. CBS sold $325,000 30-second spots, double what they would usually sell from a price standpoint for those openings. My first question, did you watch? My second question, did Harry and Meghan get paid? And if so, how much?
Okay, well, I'll answer the second question first. I definitely think they got paid.
How much? If she was able to sell it, if Harpo was able to sell it for $8 million, how much do you think they took home? 3?
Yeah, 2 or 3. That seems reasonable. There's no way that they didn't get paid. That's my feeling on it.
I mean, they're celebrity media moguls now. They've sold to Spotify, they've sold to Netflix.
Right. I did not watch the full thing. I watched clips and was kind of reading the live Twitter reactions and whatnot. I feel like I got the gist of the conversation.
What were your big takeaways? What was your big thing?
My big takeaways, obviously, trigger warning for anyone who is sensitive of topics of suicide, but that definitely stuck out to me. I think that it's incredibly sad, the position that Meghan was in, knowing that she needed help and was told that she couldn't get it. That is devastating. Can't even imagine what it's like to live in that place where you are suicidal, you have had those thoughts, and are just being refused help. Tragic. But I think my other big takeaway is like, you literally can't trust anything that comes out of these types of firms or just families or organizations or anyone of that esteem, of that power, whether it is a government official, a monarch. What can you trust that comes out of there?
Nothing.
What were your big takeaways?
I didn't watch.
Did you watch it?
I didn't watch any of it. I just can't help it. To me, it's like the baby thing. Like I don't understand the excitement over like a royal baby being born.
I don't either.
I don't give a fuck.
Yeah, like I think I watched Kate and Will's wedding, but I also didn't get the hype. Like I was never one.
I honestly think that this entrenches their power more.
Interesting.
I think just by the choice to discuss it and to own an entire night, like it was my whole feed on Twitter.
Oh yeah.
It owned the whole night despite me not watching it, and I don't understand how that doesn't entrench their power more.
Right. No, it does. It's like one of the events of the century. That is, I saw multiple tweets that said that, which I don't know. I guess I'm lacking a real appreciation for that, but
that's like those moments, though. Yeah. So I think it was there was like a tech person who's basically tweeting. It's like, as much as I think that like podcasts and digital media and these other things are the future, it's like, oh, it's still like a TV special that captures everyone's attention in such a crazy way.
Right.
We're actually way far away from all that stuff occurring. But yeah, I don't get it. I do not get it at all.
I don't either. Like, they're just people.
We're not even British. Yeah. Like, that's the thing that doesn't make any fucking sense. Who cares?
Literally, who cares? But
we're talking about it.
We are. That's a rundown.